And what about,
This meeting is being recorded.
I'd like to call to order and approve minutes of the meeting from February 8th, call tonight's meeting to order and then approve the minutes from February 8th. Has anybody looked over the minutes?
Yep.
Any changes, corrections, alterations?
I didn't see
Acknowledge them.
anything, so I'll move to approve them.
Excellent. Is there a
I'll
second?
second that.
All in favor?
Aye.
Aye.
Passes unanimously. Thank you. Is there any public comments? I don't hear from anybody. We'll move on to the pension applications. Jerry?
Can
you there?
everyone hear me?
Yes.
Yes.
Okay. We have 3 applications. I'm getting an echo.
That's, I think you're on twice and I think you have to mute one of them.
Is that better?
No, you're still logged in twice.
Let me see if I can move, mute one.
Oh,
Okay,
Try now.
All right. Well, let me get through this very quickly. We have 3 applications to submit tonight. The first one is Alicia Aim, Board of Education. She's elected a regular pension, and the option is standard. Second one is Sherry McCready Brown, also Board of Education. Hers is a regular pension, and she elected option 3. And the third one is James Santomassimo, also with the Board of Education. His is also a regular pension, and he elected the standard option.
Does anybody have any questions on these pensions?
No questions. It looked okay to me. I'll move we approve all 3.
Is there a second?
Second.
All in favor? Aye.
Aye.
Harry, before you go, just out of curiosity, 2 of these pensions are people who left Norwalk quite a while ago,
Yes,
right? And are there many other people out there who will be applying for pensions as they turn 62? Do you know?
that's always a possibility.
But we don't have a number or anything, do we?
I'd have to run a report out of the payroll system to see who is termed and their age.
Okay. All right, thank you.
Sure.
Asset allocation review.
Great. So I'm joined, excuse me, Kevin and I are joined by Rick Ford from our Capital Markets Research Group. Rick really helped us lead this project. If you recall, he worked on the OPEB asset allocation. And given the discussions we've had with the board over the past 3 to 6 months in regards to hedge funds and specifically global equity long short, and the termination of Blackstone, we wanted to revisit the investment policy and discuss our projections, given the market environment that we've just been through, the increase in interest rates, and really try to get consensus on those policy targets going forward. So with that, I'll turn it over to Rick, who's going to kind of walk us through Cowen's updated capital market projections, where we've seen changes in terms of things like fixed income, given the rate environment and our outlook, and we'll walk through some potential alternatives for the board's consideration.
Hey, thanks, Britt, and it's good to talk to everyone again. Would it be helpful if I shared the presentation on the Zoom for those of you who are remote and might not have a hard copy in front of you? James, you're on mute.
Yes, I would
I've got
appreciate
but
it.
if you want to share it, that's fine.
All right, listen to that. Yeah, now it's always the challenge of actually, being able to get there. So, all right, I think
Yep.
screen presentation should be up. Great. So as a reminder, I'm in our Atlanta office. I'm one of our specialists. So I work in a group called our Capital Markets Research Group. I work out of the Atlanta office, but I'm kind of the East Coast representative. We have 9 people on the team. The majority of the people are in San Francisco. When work like this comes up, we grab one of the specialists and we do the work and work with your field consultants to make sure that the work we're doing is relevant and implementable, right? So if you have some biases against asset classes or something like that, we try to work that information in. If we see some things that make sense that we know you might not implement, we still look at it and we kind of tell you, just sometimes, you may want to look at this, and if you tell us no, that's fine. So, and I'm an actuary by trade. So there was a question that came up earlier about the people retiring. There should be a table in the actuarial report that the actuary gives you that outlines kind of the people that are haven't retired yet and aren't working for the system anymore and their age. So if you don't want to run a report, it might be in that table in the valuation report. Real handy.
And Frank, the actuary is presenting next month, so we can ask them to.
There you go. Yeah. So, all right. So the agenda today, we want to, we'll give you a high level summary, run through our capital market assumptions that we use. We'll look at your current allocation and some alternatives, and then we're actually going to make a recommendation today to you. So, and at any time, please raise your hand or just speak up and ask questions along the way. So the fact pattern are right is that you've got 12%, in hedge funds. 4% of that we know is going to go away. The Blackstone, that's part of that global long equity short. So really, this kind of this exercise turns into what should we do with those monies, right? Should we reinvest them in hedge funds, equities, fixed income, some combination? So and then we looked at kind of removing the hedge funds, all together as well. So the long story really short is our recommendation to you is to move the monies into your core fixed income fund. We're seeing a lot of that in the public sector right now. If you were to agree with this recommendation, you'd be our 4th client in the last 10 days to move excess monies into fixed income. And the main reason for that is when rates rose so much last year, fixed income is now really a viable asset class to invest in. You can earn over 4% now in fixed income versus this time last year, we were looking at less than 2%. So there's a real yield premium that you can get and without taking excess risks that you might see in like hedge funds or having liquidity risks and things like that. All of the mixes that we looked at were in excess of your current discount rate of 6.625, 6 5/8, and that's over a 10-year period. So we're seeing that as well, that under our new capital market assumptions, a lot of our clients are now not having to reach out 20 or 30 or 40 years to have a return expectation to meet their discount rate. So that's we think that's really, really good news for the entire system. All right. So, so how does asset allocation fit into this entire system? Here you kind of have 3 levers. You've got the way you fund this plan, which is the orange circle. So you do it the standard way. You put in the normal cost, which is the cost of the accrual every year. You have an unfunded, and you take an amortization of that and you put it in. And so for this year, the contribution is around $15 million, right? Your benefits policy, you're paying out around $30+ million a year. So liquidity will be important, because if you're only bringing $15 million in and you're paying out 30, the money has to come from somewhere, and that's what the trust is here for. So we want to make sure that the trust is liquid and flexible enough so that it'll make the payments. You can make the payments without due. You have you have a drop for some members. We modeled that as well. And then the cost of living was also trying to take into account here as well. So so your investment policy, all right, about 60% in public equities, 21% in fixed income and cash, and then the balance is on what we call other or alternatives, which some are liquid, some are illiquid, but 12% in hedge funds, and then 6% in your liquid real assets, that's the PIMCO fund, and then 3% in private equity, which is in runoff. So we didn't model any more increases in the private equity since that's in runoff mode. And then there at the bottom, that's just kind of the standard formula. You know, the contributions plus the interest that you make eventually will all equal the benefit payments and the expenses paid out of the trust. That's what the trust is there for. So we're going to focus on asset allocation. We're going to keep it at a kind of a higher level. We're not going to talk about large cap growth, large cap value at that kind of a level. We like to keep it at the kind of the broad equity, international, kind of those main buckets there. All right, so before we do that, let's talk about the assumptions real quick, how we construct them, how they change from last year, and then how they affect the city's plan. So we believe we take a 10-year look. We believe in long-term averages, so we do believe in reversion to the mean. So, for example, when rates rose last year, the amount that fixed income rose in 1 year was what we expected over the next 30 years. So we had to reset basically reset our assumption there. But the Band-Aid in fixed income has essentially been ripped off, which is the best way to get out of this, honestly, as opposed to death by 1,000 cuts. We look at beta, which is the market. What are the market returns? We don't really reflect any excess returns that you're going to get from active management. We just look at that as gravy here. You know, so if you're using active management and it works for you, then the results should be better than what we show you here. Okay, and then lastly, just to make these are 10-year assumptions. Your actuary is going to look at a longer term, and that was really important last year. Probably a little bit less so going forward now, because we've seen things kind of compress. So let's talk about what happened last year. This is a histogram of the last 230 years worth of returns. The x-axis down there runs from negative 50% to about 80%. And so let's just look at between 0 and 10. Those are all the years where the equity market fell between 0 and 10. And in 2015, that was the last year we had a return between 0 and 10, and it was 1.4. So 2022, we had negative 18. And then 5 of the last 10 years, we've had outstanding equity returns, greater than 13% every year. So over the trailing 10 years, we experienced a return of about 12.6. Now, our assumption going forward for equities is just a little bit north of 7. So what we've experienced in the last 10 years is a lot more than what we would project going forward. So just to kind of set everyone's expectations. This is a chart of the yield curve. This is interest rates only. And the story here is interest rates shot straight up last year from the blue line all the way up to the orange line. And so when rates had moved so fast last year that we actually had to reset our assumptions in the middle of the year. And when we did the OPEB work, we used our assumptions that were based here on this light blue line. We had some preliminary assumptions. So rates continued to move up. So we went through our annual process and reset everything. All of your fixed income is sitting kind of right here at the 5-year mark. And so when we look at the next page, which is what we expect the yield curve to look like 10 years from now, where those two lines cross is where your fixed income is. So the good news is that we don't expect there to be really any drag for your fixed income over the next 10 years. Our corporate pension plans are out here at the far right. So they're still probably going to experience a little bit of pain as they invest in the longer duration part of the curve. But the assets that you have are sitting right here at what we call equilibrium. So that's good in that, we really don't expect the market to be moving around too much at the 5-year point. And then we have 2 models. I'm going to run through these real quick. This is for our fixed income, how we develop those returns. We start with cash and we add a premium and we come up with the numbers that are in the box. So in the box, we have 4.25. Last year, we had 1.75. So we had a 2.5% increase in our fixed income return. And when we show you your portfolio results on the old assumptions versus the new ones, it's going to be much greater, primarily driven by this increase right here. So we do the same thing on equities. So we have our metrics, and we think that equities are going to reach just north of 7%. In 2020, last year it was 6.75. And so there were 25 basis points adjustments that we made. We increased our inflation by 25 basis points. And then at this time last year, we thought the market was a little overvalued. So we just ticked our assumption down from 7 to 6.75. Well, the market is corrected, so we took that valuation adjustment off. And so that is the reason for the 50 basis point increase in our equity assumptions. You invest in hedge funds. So last year, yes, I'm sorry.
I just have one question. Do you really think inflation is going to average 2.5% over the next 10 years?
That's our assumption, and we're sticking to it.
Well, my assumption is,
But
and I bet you're closer.
let me answer a different question. If these were 1 year assumptions, the inflation assumption would be a lot different. Okay, so
But 2021 had high inflation, 22 had high inflation,
Yep.
23 is going to be over 5%. So
yes,
a couple of years ago, you guys talked about assumption of 2% over 10 years. And
Yeah.
we had that almost at the whole 30% in 3 years.
yeah, it's a question we're getting a lot. That's the assumption that we get a lot of questions about. We're constantly kind of looking at it to see, we were kind of on the fence really when we went through our process. Should it be 250 or 275 or maybe even 3? And what we didn't want to do is feel like we had a knee-jerk reaction. We want to kind of give ourselves some room if we came back next year to continue to raise it if we thought that this this short-term effect wasn't going to really mitigate over time. Yeah, that's the real answer there.
Rick, a related question. So if inflation was, if you projected it would be 3.5%, would you increase your equity returns by 100 basis points?
The inflation would flow through, yes, to that assumption. It sure would. And that's part of it as well. How much of it would flow through? A good amount of it would.
Wouldn't actually, if you had higher inflation, would probably result in higher interest rates, and higher interest rates usually compress price earnings ratios.
Yeah, yes, it does. And so, I went back a slide because I wanted to address. So one of the things that we do at the end is we look at how, our equity model is separate from our fixed income model. And then what we do at the very end is we look at the equity risk premium, and we take the cash and the equity assumptions, we compare them to each other into cash. And this assumption set came in at kind of the lower end of what the historical equity risk premium has been. So to the comment of, if we raised inflation and let that kind of flow through, our equity returns would be higher. And then we would be at more kind of a historical point of the equity risk premium. But one of the things we really want to be conscious of with our assumptions is we don't really want them bouncing around with big movements, so that every year when we do this update and Britt comes back to you, he's like, well, now your 10-year return is going to be 75 or 100 basis points lower because we were too aggressive on, a certain assumption, right? We know that we're conservative here. Some people might say, well, on the inflation, you're the exact opposite, you're aggressive. We just feel like we do have the ability to bring a little bit more in over time. We are kind of watching this to see what happens. There are a lot of Fed hikes kind of priced in, right? Let's just kind of see how that plays itself out. I know that's not probably the firm answer you were looking for, but it's the one I can give you. Because this is more the art part of the whole process. Yeah. Did I at least attempt, did I at least get a attempt there on your, on the answer?
Next
I
year you'll
didn't
be
see your, I didn't see your head nod one way or the other.
No, that's
Yeah,
fine.
and I think to Rick's point, one of the hard parts about these projections is that in an optimizer and putting portfolios together, they all have to come together at some level, and increasing inflation to 4% or what have you is not really realistic in terms of optimizing a portfolio and looking at it over a 10-year period. It's not that we don't disagree with you that we're going to see higher inflation for the short and intermediate term. But we believe over the longer term, it will level.
And that inflation is going to affect your pension liability, right? Because of the COLA. So it will have an impact for sure. In your real assets fund, you know, that's kind of what it's there for, right? Is to give you some inflation protection.
I think don't we have a cap on the COLA of like 1.5% or something? I didn't see the last contract, but
Yeah, it's usually everybody gets a COLA every year.
is it a cap on the contract? The contract used to have a cap of 1.5%.
It's just 1.5% each year
Okay,
for the
Yeah.
COLA increase.
yeah. And so we wouldn't be as affected by inflation because COLA is only 1.5%.
Okay, yeah, there's a plan that I work with. They cap the COLA at 2, but if inflation is 7, then they built up a credit. So that 2% does flow through until they've kind of caught up, if you will, for lack of in air quotes. Which is another issue all in itself. So our hedge fund assumption increased because it's a blend of equities and fixed income. And what we're really seeing right now with our assumptions is having fixed income at 4.25 and hedge funds at 5.5. Fixed income looks really, really good in the model versus last year when hedge funds were 410 and fixed income was only 175, right? There's a huge spread in there. And the model really was attracted to hedge funds. We're seeing a lot less of that now, which is kind of driving that point I made earlier about people moving into fixed income. If you can get a 4% yield on your fixed income without all the hassles of a hedge fund, it might be worth it. Private equity, this increase was a straight pass through of the valuation adjustment and inflation. So nothing really special there. And then this is the comparison of the assumptions a year ago versus now. In the fixed income space there, 2.5% jump, and then 75 bips on equities, and then everything else just kind of jumped up in relationship to how it was before. This is so everything kind of hangs together. So the last slide on the capital
This is the
markets.
chart I was referring to.
So the capital markets have kind of changed over time. You know, in 1993, which is what is that, 30 years ago now? For those of us who can remember being around then, right? All you had to do to get 7% was be, basically in core fixed, right? And as those yields have compressed, and gone down over time, you've had to inject more risk into the portfolio. So 2008, you could get 7% with just stocks and bonds. And then 2002, this was really the peak of when rates were really, really low. You were 97% in risk assets and only 3% right here, or I'm sorry, 4% in fixed to get your 7%, and you were at 17% risk. And then now that fixed income is back to being a viable asset class, it's about 1/3 in fixed and 2/3 in other things, 11% in private equity. So when I show you an efficient frontier later and you try to lay this point over it, it's going to be well dominant to your current policy, and that's driven by this private equity line. It's 8% more than what you have now.
You have real estate in there. I mean, it's been getting pounded.
Yes.
I mean, I can't imagine it's going to have a return that much this year. It's already way underwater.
Yeah, we lowered that assumption. We lowered that assumption. We think that there, There's still some write-downs to happen this year. But it's kind of like your equities, right? Equities were down 20% last year. I'd rather buy equities now than I did a year ago, right? So if I'm fishing for the bottom in real estate, yeah, I'm probably going to wait for a while. We do have some clients that are kind of on the sidelines, ready to kind of jump into it. We're gonna dollar cost average them into it over time, so that if the market does continue to go down, they're buying more at a lower price. But we want to get them fully invested over the course of the year.
Do you think we're gonna have a recession?
Oh, do I think we're gonna have a recession? I'm not sure. I mean, personally, if we have one, every 2 weeks in my 401k or twice a month, I'm going to buy lower than what I had before, right? I mean, I'm going to rebalance my portfolio. I know that's not, it, but I don't try to time the market. One of the things that, one of our last, what I call Callan version 1, Ron Payton says, pick an asset allocation and, pretty much stick to it and rebalance, right? Because, when the market goes against you, you want to buy low and sell high. But I don't know. I really don't. I don't have an opinion one way or the other. I know some of my colleagues do. There's not many that are going through saying we're not going to have one. So what do you think?
I think it's tough to be optimistic.
Yeah, I'm curious. What do you
going
think?
on in the world? I would say that much.
I mean,
Yeah.
it just, yeah, I mean, like things like real estate, in other recessions, it's really been rushed.
Yeah.
And we're coming off COVID.
We're coming off COVID, there's a change of remote work. There's a lot of like debt that's at low rates that has to be refinanced.
Though I think I would say, at least with regards to real estate, one thing you have to separate is like core real estate, which is what's getting crushed, and you see all the redemptions. So, and that's primarily a lot of office space and retail versus the non-core, more opportunistic kind of niche areas of the market. They're actually still doing quite well. So that's
Industrials, self-storage.
apartments, some medical. So there's still an opportunity to earn a return out there, even in the face of a recession, right? Like the economy and the markets do not necessarily move hand in hand. And I think that's to Rick's point earlier about, some of that already being baked in perhaps.
And given where we are in the cycle, I think most of the private real estate returns are income. They're not appreciation. We're
Right.
seeing the correction in price appreciation, and we're seeing the lagged returns flowing through,
Yeah.
continuing, and we expect that to continue. But I think, the optimistic part of the portfolio is, those fully leased legacy assets that are really driving the income return and the yield in private real estate funds are still healthy, but the price appreciation is certainly.
And if you're that's right. If you're in a position of strength as a plan, if you stayed the course, kind of again to Rick's point, and sort of rebalancing and stay disciplined, and you have some liquidity, you're in a position of power potentially for something like real estate to pick it up at a reduced value going forward. Just as, not saying it's real estate, but other opportunities as well in other asset classes.
One of the things, so for us, liquidity is important because we have a negative draw.
Right.
And that negative draw is just going to continue to increase.
Right.
And we're not proposing adding real estate.
Right. It
No.
could be liquid asset classes, but
More importantly.
there'll be opportunities. Yeah.
Well, and I'll say one other thing, I guess, if things don't flush itself out this year, with next year being an election year, there's not real certainty in there. I think we're just gonna see a real sideways all the way through until we get to November, until there's a real crystal cut winner. I always tell the story of, it was the year of the hanging Chad, Al Gore and Bush. The market was up 12% that year, but it was only up 50 basis points until Bush was declared the winner in the middle of December. The last 2 weeks of the year, the market shot up 11.5% because it was just waiting to see. It wanted that certainty of who was going to win. So, and I don't think there's there's no clear cut any year. You know, even when there appears to be a clear cut, the Republicans sure don't know what they're doing. And I don't think the Democrats are coming back with, you know, the same side. So it could be a long year. You know, it could be, you know, it could be a long rest of this year and a long next year. So when we look at the change in the assumptions, there's your 120 basis point pickup right there. And this is what, so the new assumption set is really helping you beat your expected actuarial return of
But
6.58.
just in passing, the column that says policy 2021 assumptions adds up to 96%, not 100.
Yeah, that's because I don't know how to do a spreadsheet. It's the same as your policy though. Yeah, the hedge fund should be 12 there, so. One day I'll be the actuary that doesn't stink at math, so. So you're, you know, so this is a pie chart of your existing allocations as of the end of the year. On the table on the right shows the variances to policy. The red is just means you're below, the green means you're above, but nothing's outside of policy. So you're good to go there. 6.8 is your expected return going forward with a risk of 12.5. And in a vacuum, that doesn't really mean anything. But when we start comparing to the alternative policies, it'll mean something to us. So we really looked at 3 different proposals, and then this column on the one on the far right, that is the allocation that's needed to meet your discount rate of 6 5/8. So just, you know, I always like to look at that because if you can move a ton of money maybe into fixed income from where you are, might make sense to take a lot of that risk off of the table. So as we move across, right, what are we doing with that 4% from Blackstone? Proposal 1, it puts it, I'm just going to read it here, sorry. It puts it into public equities. Prop 2 puts it into fixed. And then number 3 puts it into both equities and fixed. And then, and we reduce it by 4% more as well. Okay, so not really moving the needle too much here because there's nothing broken. So if there were things broken, it'd be a lot. My job would be a lot easier. But that Britt and Kevin have done a great job of keeping everything on track here. So this chart here is what we call the efficient frontier. It's a kind of a zoom in of a portion of it. This line represents what we call efficient frontiers, and any dot that is north of the line gives you more return. Anything to the left gives you less risk. So the policy, so all of these proposals sit on the efficient frontier, which is a good thing. It means you can't extract any more risk or any more return out of the risk. Now, when we were thinking about our 7% return number, it would sit up here where my cursor is. That's the effect of all the private equity. So we limited the amount of private equity in here. So if you want to push this frontier out, you have to kind of expand the amount you're going to invest in some of these alternatives. The discount rate, which is this is the minimum amount of risk that you can take and still meet your discount rate. So not a big change there from your other policies. So they're all pretty much kind of lumped here together. And as you would expect, as you add equity, you increase risk and return. And if you move to fixed income, you reduce risk and return. So we are recommending that you move here to Prop 2, which is moving the 4% into fixed income, because you're basically getting the same amount of return at a little bit less risk. Okay, and you just don't need more risk because you're already beating your discount rate. So there's no need for you to inject more risk into this portfolio. The next 2 charts show a distribution of the returns. This is what your return stream would look like in any one year. It's a 2 standard deviation model. So it's a pretty wide range. The middle of the numbers there represents the mean. And if you're on your game, you're going to say, wait, these numbers are way higher than what you've been telling me. These are a lot higher than the 6.8, 6.9. And the reason for that, this is the return you're going to get in any one year. And when you start injecting volatility into a portfolio, that median return goes down. And the example I like to use is if you have $100, you earn 50%, you have $150. If you lose 50%, you're left with 75. But 50 plus 50 minus 50 is 0. Well, your return wasn't 0. It was negative. And that's the effect of having your portfolio go up and down. So when we look at page 10, the distributions are a lot tighter because we're not going to have plus 50 every year. And we're not going to have minus 20 every year. So as things revert back to the means, the distribution is a lot tighter. Not a lot of change here. Not a lot of differences because we're moving the needle very small. But your number 2 gives you a nice tight band. It gives you a 52% chance of beating the discount rate. And it's it has just a tighter band and then go into more into equities, right? And as you're amortizing these unfundeds, right, the bad years are going to, they're going to make that unfunded get bigger. And that's going to make that contribution requirement a little bit bigger in those really tail years, right? So contributions, they're not going to go negative, but they can get big real fast, right? And so managing the distribution of the returns, that's where it kind of, you're going to see it on impact on down the road.
So your actuary smooths out the contributions over 5 years.
Right.
So the ride that you take matters. So if you take too much risk, you have a really bad year, it's really going to affect that smoothing versus having a more reasonable asset allocation where your ups and your downs are not as volatile will help that path forward.
Are we still under the, we're still going to cut by another 25 basis points,
We're going to 6.5.
6.5,
So we're going down another
8.
8.
I think that we're gonna, the other thing too is because rates are coming up. At some level, if rates were higher than our assumption, we just put it all in bonds. I'll buy my own
That's
chips.
what the corporate world does.
Yeah.
Easier game.
Yeah.
Rick, what market conditions would cause you to rethink this in the next year or so?
The recommendation,
Yes. Yes. So, yeah, what would cause you to rethink this and recommend a further change?
if we saw, let's just say if we saw a reversal of what happened in 2022 and we wake up and instead of fixed income earning 4, now we think it's going to earn 175 going forward, right? Two things are going to happen. One, the fixed income you have is going to be worth a whole heck of a lot of money because because when rates go down, the value of those bonds goes up. So I think we'd come back and we say, one, you need to rebalance. You go ahead and rebalance, take your gain, turn the fixed income, and then we would take a hard look at what's the portfolio return going to look like going forward. Because if we believe in reversion, the mean of those rates are going to come back up, we might want to dial back the fixed income that we just put in, maybe move that back into equities or another alternative asset class. But it'd have to be a pretty significant shift.
Yep.
If we saw a big shift in the equities, in fact, last year is a perfect example. The only reason we redid our assumptions mid-year was because of the movement in rates. The equity market was down 20%, and we were not redoing our assumptions because of that. We redid it because we were doing everything else, but it just was kind of a byproduct. So if we were to wake up and the market was going to correct 20%, I'd say rebalance, buy low and, buy low, right? Because what you're most likely going to see is if there's a correction, we'll see a flight to quality, rates will fall some, your fixed income will be more valuable, so you'll be out of whack, right? So if you just go ahead and sell those winners in your fixed income and buy the equity at 15% loss, I'll take that all day long.
Yep.
Right. And you'll make a good chunk of money just by having the discipline to rebalance.
Okay, thanks.
You're welcome. So to repeat again, this no, I think the only point I haven't made is in 2022, that's only the third time in the last 100 years that both stocks and bonds have been negative in a calendar year. It happens about 10% of the time in the quarters, but they usually, there's a reason we have a correlation to zero. Stocks and bonds are, randomly moved together, but last year was unusual. Fixed income rates are up, equities are up a little bit more, and under the new set, you're going to beat your the assumption is that you'll beat your discount rate over the 10-year period. Versus-
One of the things that I find interesting is I think the last 2 years that both stocks and bonds were down. People talked about the market was up, but that was 26 and 69, right? And 5 years later, the market was lower.
Yeah, not saying that the market's not going to be lower for sure, but it's just unusual for stocks and bonds to both lose money in the same year. Right? Last year, bonds lost 25% and stocks lost 15%. There wasn't, the best place to be was cash. Right? Because you kept it, right? And Brett, I don't know if you've got the periodic table in the big book or not, but that's kind of the story from 2022, right? But cash is not where you want to be in a normal year. So the recommendation, take the Blackstone proceeds, put them into core fixed.
Thoughts, questions? I
Yeah,
think the bulk of this exercise was really to take a deeper dive into the hedge fund allocation, given all of our conversations. The fact that Blackstone's going away. I think at last month, we heard from ABS. I think the general consensus was to continue with them for the near term and reevaluate them in 2024 for the time being. We are proponents of UBS, absolute return strategy. We think they've done well for the pension plan and really being a diversified source of return. And certainly had a great year last year. And our best recommendation, given the rate environment, the outlook in fixed income, would be to take the policy target of 4% away from global equity long short that Blackstone had and move it into fixed income.
Yeah, I think that we'd agree that we're not big on long short, right?
Yeah.
So, I think that Jim, you kind of agree with that also, don't you?
Yeah, I agree. It's hard to tell if long short just has had a bad run or if the world's changed enough, but I think, being able to get pretty close to the same projected returns with much less risk seems to make sense.
Yeah, we can get more without the risk. If you look at it over the last 7 years, they haven't really performed very well. Right now we could get probably more, in a bond fund. What about a fund that is a little shorter in duration? You're averaging 5 years right now, but in the curve, the 2-year, somewhere in that area is yielding 100 basis points more than the 10-year, right? And that would give you,
Well, that's exactly what you're talking about right here. Is this 2-year, we expect that part of the curve to fall, right, as we move towards equilibrium. I'm not going to argue against it. That's for sure.
Yeah, but we have a much more compressed time frame in order for that to happen.
Yes. You are going to be giving up some return expectation doing that.
Well, and you're also going to have less time. The future's going to happen
Pivot
sooner.
away from it.
Yeah.
You say on page 15 that hedge fund return projection 5.5%. That's better than what you're projecting for fixed income.
Yes.
Why aren't you recommending other hedge funds not not long short.
I see, because of the risk of the hedge funds. And so,
Yeah, but don't we have to make a, we're putting a greater percentage of the whole fund into fixed income. I think your recommendation puts a third into fixed income. And you're projecting 4%. So the other 2/3 has to earn a lot more to meet the 7% that you're projecting. So wouldn't it be better to put the more into other hedge funds at a higher return than into fixed income, so we can at least make the 7%?
yeah, if you want, I mean, if you do that, you're just gonna get you're just gonna get more risk in the portfolio.
Or we're gonna get more return as well? I mean, that's what you're
That's
projecting.
right. And
Well, Charlie, it depends. I mean, we're coming off of a 10-year period where we haven't gotten that return from hedge funds.
Yeah.
But the risk and the volatility has been there. And I think that's the reason Blackstone was terminated.
I understand that, but that's one strategy. There are other strategies. But why are you
And I think-
projecting 5.5 then if you think they're not going to make 5.5?
so,
I think, Charlie, right now, domestic fixed income is at, is 18%, right?
18% of the fund. Yeah,
Yeah. And, you know, I mean, a lot of people think 60-40, which we're not gonna do ever, but probably, but, you know, we have real assets and absolute return in that kind of bucket. So it wouldn't be that, we wouldn't be really, I think, out of line with, you know, fixed income. And you know me, I'm not a big fan of it, and I haven't been for a long time.
Yeah, it's a 4% increase at the end of the day to fixed income, or to Charlie's point, to hedge funds. So I don't know if for 4% of the portfolio, you need to chase what I would say is significantly more risk on the hedge fund side versus 1% less capital market assumption. on
The other thing
fixed
is the
income.
assumptions, you know, projections are gonna be, I think if we look a year ago, the projection for the stock market wasn't that it was gonna be down 18%. So I think that
Correct. These are projections.
these are projections, so I think that, you know, to maybe go even with 2 and 2. Stocks and bonds or whatever. What do you think, Coach?
I would allocate it to fixed income. If we can, if we can lower the portfolio risk and still maintain a pretty decent spread over our discount rate, and we're looking to lower the discount rate again. I mean, that seems like pretty much of a, without lowering risk, increasing the spread to the discount rate, that seems like a win-win to me.
well,
Jim?
and if you do lower that discount rate again, you're just increasing the probability of having actuarial gains every year on the asset side, which are going to kind of bleed in and help you over time. You know, when you don't have them, right? In the
And if you can do that with less risk, you have even a higher probability of doing it.
That's exactly right, because you know, when the smoothing is the smoothing, right? But there are limits on it, right? And if you, when you push that thing, when you push the smoothing to its maximum, and that unfunded gets bigger, and I believe you have a closed amortization period, so that's ticking down over time, right? 15, 14, right? So you're going to recognize a lot more of that tail in those tail events, right? Which is going to be a direct hit to your contribution requirement. So,
Yeah, kind of an operational question for one of the Callan folks, I guess, is in our portfolio, when we're buying corporate bonds, how much influence or what I guess transparency do we have into the duration, the average duration of the bonds in our portfolio?
So Jim, both of the fixed income managers in the pension are benchmarked to the aggregate. which has a duration of what, 6, Rick, 5.5,
6.5,
something.
yeah,
Okay,
yeah, still getting used
and
to
that-
it, yeah.
And the portfolio managers have the ability to tweak that on the margin, but I think both of these fixed income managers are going to stay pretty close to the benchmark. I think playing with duration is a difficult game to play,
Yeah.
to say the least. So they're really
Yep.
going to be right around that at 5 to 6 years.
okay.
It's
You know,
well,
I mean,
and I
one
want to address something that Charles said earlier, because about, do we just stay in hedge funds and get the return? The very interesting thing that came out of this study for me is that as you move from hedge funds into equities and into fixed income, all of these portfolios stayed on the efficient frontier, which means that the risk reward trade-off between equities, fixed income, and hedge funds is in a very unique place. You don't normally see that. Most of the time, if you were to increase your hedge fund allocation, you would see the portfolio move north and west of the existing portfolio, which means which is a short way of saying it's a no-brainer portfolio. But because the fixed income returns have come up so much, it's really a trade-off. And so now it comes to some of the softer operational things, like, do I want to deal with my money being locked up? Do I want to deal with an asset class that's really struggled, right, to meet the return expectation? Hedge funds have, right, they've had challenges, they've had headwinds in front of them, and nothing to do.
But on page 15, when you have 2022 and 2023, and you had 2022 inflation at 2.25. I mean, I guess those are your assumptions, but we all know it wasn't that. It was like 6.5%. So why doesn't this chart show 6.5%? And the other thing is cash at 275 for 2023. I just bought a 6-month bill that paid 527. I mean,
These are our 10-year projections. So
well, he's got
last year's.
23, 2022, 2023.
It's the
10-year projections.
Off of the, I guess,
Yeah, so from what you can see how drastic the changes have been from our 10-year projections last year, given the market environment that we just
Right,
experienced.
I guess, so he's talking about basically hedge funds being 5.5% on an average over 10-year period.
Right, correct. And I think most of that's driven by the cash yield that they did not have previously.
That's right.
Remember with ABS Global, they said that now with rates being higher, you can actually make some money
On the short side.
on the
borrowing,
short side,
right.
but you can make the money in cash. Why the hell take the hedge fund risk?
Well, some of these, but a lot of these funds now, they charge you to short the stocks, right? Because there's a shortage of the stocks.
Yeah,
Yeah,
Rick, it's
and
kind of, yeah, this discussion is kind of getting to, what's your view of, what was wrong with hedge funds for the last 5 to 10 years versus, 15 years ago? Because they did have a bad run here. Was there something in the economy and the markets was it the low inflation that did that? What's your view on that? Why hedge funds underperformed? Or there are just too many of them out there now, maybe, I don't know.
No, there was elements in the marketplace. I mean, for one, shorting was completely out of vogue for the last 5 to 7 years, and the market, everything just had a tailwind behind it. But there is also a lack of dispersion, right? I mean, we've seen some of that come back to the marketplace in the last 3 to 6 months, which is what hedge fund managers will traditionally feed on. They need that dispersion and volatility in the marketplace, and we just didn't have that for so many years. So it doesn't create an opportunity set for them to actually perform well. Those would be the first 2 things that come to my mind. I don't know if Britt or Rick have anything further.
But almost every hedge, a long short fund is net long.
Yeah, if we want to pick up, we want to take advantage of the dispersion. That's why we have active funds.
Right.
Right.
And we can do that without taking without having the liquidity constraints
Right.
of the hedge funds.
The hedge fund, right?
Increased fees,
Yeah, yeah,
complexity,
yeah.
et cetera, yeah.
See if our active managers can generate returns or alpha, rather.
Well, what about, so with these funds, first of all, the other thing is, I'm skipping down to number 6, but what about Chitsame, what about cash? What do you need for cash?
Oh, we're ready for cash?
No, just because the idea of where we're gonna be placing things
So we can,
relative to where we're gonna be maybe taking money out. And if actually, didn't you tell me you were getting over 4.5% or something from somewhere around there?
It's a short-term investment fund. Right now, it's earning at around 4.6%.
So if we're gonna need cash for 3 months, do we put it in
It's just-
4.6%, no risk,
It's the same, yeah.
right?
yeah, and we'll discuss, because we also have part of the Blackstone redemption that's gonna hit next month. So the amount of money that needs to be raised before June is a very small amount.
Yeah, so that's, what do you think we need between now and June? Because you'll get money in July, right?
Right, we're gonna get money from the Blackstone. I believe it's April.
Yep.
That will get
Yeah.
around 4.9 million. So we only need 3 million to get us through June right now.
And what about, and then the city will provide funds in July?
Yes.
But they're not gonna, do you know what the amount is? Because I know the budget's up now.
Oh, I don't have it in front of me, but I know last year, I think it was around 14 million. So
Yeah, it's-
I would say it'd probably be around the same.
Yeah, I
But isn't
think
it
it's
the-
15.3. I think it's 15.3 that's coming in.
We'll
Uh-huh.
confirm with the actuary when they
Yeah,
present that
we-
this month.
Yeah, we have the reports too.
Okay.
So, so does it come in on one lump sum or monthly? It sounds like it's a lump sum payment into the trust.
Yes.
Yeah, so your liquidity needs are, you have none in July and then 12 months, right, and for the next 11 months, right? You have to figure out where the money's gonna come from. Okay. Yeah.
And that can be a conversation, what
Yeah.
of that contribution is reinvested versus holding in cash
Mhm.
to earn a little bit of risk-free interest and continue to pay benefits. I don't think we would recommend all of it staying in cash by any means, but certainly open to the board's opinions and what will best suit the pension plan.
So what you were proposing earlier is we take 2% and put it in equities and 2% into fixed income.
Well,
Is that what you,
we would probably need 1% just in cash.
so,
I mean,
The policy currently has a 2% target to cash. So we don't need, so Blackstone's already in liquidation. We've already received two of those
Two of them.
two of the payments, which the payments have been used for benefit payments.
right,
Three more expected, two larger ones, and then a holdback.
how much
There's
is the
no,
holdback?
I don't know exactly. We can try to get an update from Blackstone. So there's no immediate sale or purchase that needs to happen based on
Right,
adopting a new asset allocation. Once the board decides whether it's to take 4% away from hedge funds and put it in fixed income and or equities, we'd want to bring back the investment policy statement, review the new targets and ranges. Once that's adopted, we can come to a plan on how to get closer to those targets. But given this is a small move,
right,
all things kept equal, and the city's contribution coming in July, there should be no sales. A portion of the contribution can be and reinvested to meet those targets and stay within the ranges. And a portion can be left in cash to pay them.
yeah, give more time for your inflation forecast to work out.
well, the thing is, the Fed's gonna raise rates again and keep the money short term, right?
Well, we don't have any money to keep
No, I mean, but, right,
well, in 6 months, we'll have something to do. We don't have anything to do right now.
right, we don't have anything, so we're not gonna, you're right, we don't have any cash to to allocate now. These are beliefs that
So
when we got money.
exactly. And the idea here would be get consensus for the policy changes. Given what we presented today, we'll bring back the investment policy statement to review and update accordingly. And then once that's adopted, we will work with the board to make a plan on how to get to the updated target policy.
But our targets are broad, so we'll fall within the range.
That's,
Right.
yeah, that's right. This is strategic long-term asset allocation targets. You don't have to land on 2% at any given time in cash. If you needed a little bit more, you felt like, then you can certainly float north of that.
And one of the revisiting the IPS is we can revisit the ranges. And if we want to increase the cash range, for example, we can do that so that there are no issues in leaving a higher amount in cash that's paying
Right.
a higher interest rate.
Okay.
Perfect. Any other questions? If not, we're gonna move on.
Hey, Rick,
I guess, is there consensus on
there's
how to move forward?
There's one thing that I'd like to see over the next, and not anything that has to happen right away. And this kind of reflects, the idea if inflation turns out to be instead of 2.50 10-year, turns out to be 3 or 3.5, you can pick. What's the sensitivity of the allocations? I would, that would help me. If we could have a little bit of sensitivity analysis. I don't know what the hell it's going to do, but if within the framework of your model, I can get a little bit of a better feel of if we're wrong, what's going to be the implications, so that we can make we can add that into our thinking. If it's 3.5% and having that allocation of bonds doesn't hurt us.
Right.
Versus something else. That says one thing. Versus
Okay, and I think the flip side of that would be is how high does inflation have to need to get before we would definitely see a change, right?
yeah, I mean, that would be very useful also.
Okay. That, because as you were asking me, I think that one might be, I'm just thinking about how we set our assumptions, that might be the easier thing to answer. Right?
How high would we need to go?
Yeah, how high would we, what kind of market shock would we have to see for us to come back and say, all right, we need to do another off-cycle adjustment?
Yeah, okay.
Historically, if you look going forward, so let's say hypothetical inflation's 100 basis points higher than what the market is projecting now. Presumably, fixed income yields would go up, prices would go down. Equities would go up, maybe not by the same amount, but they'd go up.
Mhm.
So net, that would cost us something. I mean, the short term, we could sell the bonds at a profit and probably be okay, but longer term, we'd have to fix the allocation, right?
Yeah, in order to keep your 6 and 5/8, beat your target, you would need to risk up into the equity market. Yeah.
But I think, Rich, part of the answer to that is in the short term, meaning probably 2, 3, 4 years, we're reasonably protected, because if inflation is a lot higher than the market thinks it is, we would benefit with bond prices going up. And I'm not sure if it would offset, you'd be better off with equities or not, but we'd certainly do all right with the bond prices going up.
Well, that's my sense too, but I just wanted to put some numbers around it.
Yeah.
But the one thing is the money that we have already invested in bonds, we would lose money there if rates go up. All right,
We already have,
Well,
well, I know we already have, but I mean,
but yes.
if the 5-year goes to 6%, we're gonna have a lot of red marks in here again.
Well,
I'm not saying it's going to, but
Pace of inflation is certainly key element as well, right? How quickly we see any sort of.
Well, even I mean, the yield curves with the 2s and 10s is 110 basis points today or something like that, and when was it ever like that before? So.
Yeah.
Because could the 10-year move to a normalized yield curve would have the 10-year right now at 5%.
Well, in your equities, under that scenario, you lose money on equities too, because there'd be a correction.
On equity.
So, yeah. Under, Jim's thought process, right, that he's thinking about it through the 10-year time horizon, right? But, all this 1, 18, 24-month stuff, right? That would just change the inputs dramatically. So, and we really don't want our clients making short-term decisions like that. We're not tactical, we're strategic. That's always been our story.
Well, one good thing about all this is that equities are more reasonably priced now than they used to be.
Yes,
So
they are.
that kind of,
They're
mean,
firm at lower levels.
well, I mean, but it's one thing adding money when you're more than one standard deviation above normalized returns. Well, I don't like, I'm not sure I was a big fan of that.
I guess it's a matter of how much risk, if we did have money, where would we put it?
Yeah.
That's basically it. Could you have another year of down stocks and bonds? It's not out of the question.
Well, and
I'd like to have some dry powder if we get a.
Yeah, I mean-
09 again, so.
Yeah, and really, like, if we're gonna get, by the time we get money in April, the Fed's gonna raise rates again in March, whether it's 25 or 50, I don't know, but. So May could be getting closer to 5% almost, right? So, and then we could sit and wonder what to do.
Sounds good.
So in terms of next steps, we'll huddle up with Rick to discuss how inflation, what kind of scenario would drastically change our recommendation and or the potential mixes. Is there consensus with the board on our recommendation or splitting it between equities and fixed income? I mean, this is not a decision that needs to be made tonight by any means. But in terms of, next steps, reviewing the IPS, confirming the asset allocation in the coming months or next 2 to 3 months.
I don't think we need to, we're not gonna make a decision now. We don't have the money now. And in April, we'll see what the needs are and then also where the markets are.
Things are in the fall.
Yeah. Okay.
But yeah, we
Is that okay
all
with
the
you,
other steps.
Charlie? Okay with you?
Thank you, Rick.
You're welcome.
Yep,
Sure.
I'm good
Thank
with
you,
that.
Rick.
Thank you all. Look forward to catching up with you on the analysis. So
Okay.
Thank you for your
Take care.
time.
Yeah,
Thank you. Thanks,
You're
Rick.
welcome.
Okay.
Performance review.
Okay. We're planning to go through the January flash reports, if that's okay with you.
Yep.
Kevin, do you want to provide a kind of a quick market backdrop and then I'll run through performance?
Yeah, quick market backdrop, maybe I'll touch on both sort of January and February, given we're already in March.
No forecast there.
Safe to say that it was a tale of two cities. Came out of the gates pretty hot in January. I think it's fair to probably say it was a risk on environment. Inflation had waned a little bit, and I think it was the first time we saw headline CPI actually decline in the past like 7 or 8 months. S&P 500 was up over 6%, and interestingly, a lot of that was on the back of mega cap tech names, which had been some of the biggest losers in 2022. Overseas, same sort of story. MSCI EP was up over 8%. Emerging markets were up just shy of 8%, with Chinese equities, I think, like 12% return. So stellar start to the year. And then, unfortunately, we saw February kind of go the other way. The sentiment around inflation, it totally reversed course. We saw CPI kind of reveal some increased inflationary pressure, and many people felt that this was a signal that the Fed was going to continue to increase interest rates, higher and for a longer period of time. And as we know now, that probably will be the case. And so all of that kind of coupled with some lagging corporate earnings, as well as the Russia-Ukraine conflict entering into the second year, caused a lot of investors to pull back. And so we went from the risk on to the risk off. S&P fell about 2.5%. Overseas, similar story, hit pretty hard. And bonds were challenged as well, given the inflation concerns. Ag fell about 2.5%. And Frank, to some of your earlier comments, we kind of continued to see that inverted spread in terms of the yield curve between something like the 3-month and the 10-year. They're actually at like that spread is actually at a historical level now of almost -1%. So it's a topsy-turvy market once again. And so much appears to be hanging on inflation commentary at any point in time.
Yeah, I think the only thing I'll add that you'll see come through in the January report is that the US dollars weakened pretty considerably compared to 2022, where it was extremely strong, which has helped your international equity returns pretty substantially.
That's kind of reversed over the last few days.
February was correct. I said January.
Yeah.
New high
Commentary
off
will be
of,
based on when.
Off of Powell's comment.
Yeah, absolutely. So if we turn to page 3 of the January performance, just showing the asset distribution, not a lot of change from last month when we reviewed December. Slight underweight to total equity. You can see that's really US equity slightly underweight, as well as global equity long short. As Blackstone is redeemed, you can see about 4.9 million hitting the pension fund from Blackstone. And again, we expect a similar distribution payment at the end of April. Domestic fixed income slightly underweight, and PIMCO real assets, as well as UBS absolute returns slightly overweight. So total assets about 480 million at the end of January. We show performance on pages 4 and 5. I think the good news is from a fiscal year standpoint, you can see a pretty dramatic reversal given the second half of 2022, specifically the fourth quarter was positive in risk assets, as well as in January. LSV continues to do very well. You can see up almost 18% fiscal year to date. Positive 7% for the last year versus a negative return of 50 basis points for the benchmark. And you can see their returns have really come back after struggling in that growth market environment. Columbus Circle really struggled in the fourth quarter, largely due to some of their tech and healthcare names. We do want to have them in probably May to present. Longer term, their numbers are extremely good. And they have not pivoted a whole lot since the fourth quarter, where they were down about 5% versus the benchmark, which really hurt their 1-year return. So we'll continue to keep an eye on them. Artisan, which is being replaced by Walter Scott. Speaking to Chitsime, the paperwork for Walter Scott is complete. So as soon as she receives the blessing from Walter Scott to fund the account, we will begin the transition from Artisan to Walter Scott.
How long do you think that'll take?
Artisan's daily liquid, so
You
it
can just do it anytime.
shouldn't take more than a few days. See Silchester slightly underperformed the value index. No real concerns there, given their intrinsic value approach. They did have a good year versus the EFA index, the broader index, and longer term continue to be very strong manager. We saw BlackRock Emerging Markets have a good fourth quarter. You can see fiscal year to date up about 70 basis points. And then within hedge funds, ABS, positive 4% return over the last year. They have done reasonably well, protecting on the downside, but we will continue to keep an eye on them. The private equity returns are lagged, so this is really just one quarter of returns. And the dominant allocation for Norwalk is in that US Select 2014 fund, which was down about 70 basis points. In general, private equity valuations have not been nearly as negative as we saw in public markets. Kind of mid-single digits is the expectation, but again, this is a reporting.
There's no trade.
So we expect it to continue to flow out, but it is
It's a good business model.
it is less transparent to say the least.
Has there been any movement? There's no capital calls anymore,
No,
probably.
no.
Are we getting any money from them?
No, I haven't seen any lately.
Now, in our full report, we have a complete detail of all contributions and distributions each quarter. Let me see if I can pull it up quickly.
Because I mean, it's still almost 5% of the portfolio.
And a lot of that's being driven by the denominator effect from public equities and public fixed income being down so much in 2022. All of our clients' alternatives have really spiked given the lag in valuation. And that is expected to correct itself. And I think 3%, that's really a long-term target as it continues to wind down, reevaluate it as distributions continue. Just pulling up.
But we haven't had distributions much. Have we?
Let me see.
I mean, some
We
of this-
have, so
but some of this
we've
is,
gotten about between 250 and 400,000 per quarter over the last 2 years from the 2014 fund.
but these other funds, aren't they just kind of,
There's almost nothing.
Yeah.
Yeah, they're in wind down and very few investments under the hood and really the manager is looking to sell them in the secondary market as they wind down.
didn't they tell us, so we're gonna take a hit on that stuff probably?
Well, I think total, the other funds,
So you got,
It's under one
It's-
point.
you got about 200,000 from USA 6 last year. You got another almost 300,000 from USA 7 last year in distribution. Europe fund lower around, call it 50 or 60,000. So they're still kicking off a little bit, slowly but surely.
and then the older vintage funds, there's about less than about 1.3 million total.
Right, didn't they tell us? so?
What's your expectation when we'll be out of those funds?
Wish I could answer that, Jim. They seem to ask for extensions. 1 year extensions. At this point, Chits knows she gets all the details. I think some of these funds are, pre-2008 inception dates. So they're reaching their lifetime and the manager is going to have to exit them in the next 3 years.
Okay,
I mean, some of these. I think one of these funds goes back to 2002 or something like that.
Yeah, I think
mean,
you're right.
I mean, that's one of the reasons why, like, at least to me. By the way, I remember these guys telling us, oh, they'll be out in 5 to 7 years. You
Get out
know,
of our minds.
yeah. And that's gonna be played for the NBA next year.
Yeah, the USA 4 fund was back in 2001.
Yeah.
Yeah.
I don't know if that's when you entered, I assume.
So just wrapping up performance. Fixed income, slightly positive. Your core manager Prudential has done well fiscal year to date. And UBS continues to do well as well as PIMCO. So fiscal year to date, total plan up about 7.3%. Versus a benchmark of 6.4, and as difficult as 2022 was, we are glad to see some positive numbers there contributing to this fiscal year. And longer term, you can see the 5 and especially the 7-year return, almost 7.5%.
Nobody's on the watch list, are they?
No, I think the manager we want to have in and are keeping a close eye on is Columbus Circle. If you recall, Cliff Fox retired about two years ago. It's part of Prudential now. And we think that's a positive, but their asset base is still very small. And especially the SMID growth fund that you're invested in, I think it has 6 total clients. So really that's the biggest concern. I think we're comfortable with the team. Long-term performance continues to be good, but with the new portfolio manager, Chris Corbett, a rough fourth quarter and not a great 2022, we want to keep a close eye.
Are you looking at SMID alternatives? A lot of SMID funds now, right?
There are.
It's been a hot area.
It has, and we look at a lot of SMID growth funds for a lot of clients. There are certainly a lot of great managers out there. I don't think, based on feedback we've gotten from the board, that there's any desire to do that yet. And I think, part of the due diligence has probably been 18 months since we've heard from the new portfolio management team. And I think just having them in, letting them talk about their positioning, their outlook, and making sure that everyone's comfortable going forward.
Do you think it'd be worthwhile to have a context of what SMID alternatives would look like with them?
Yeah, we can certainly do that. I mean, I will tell you right now, take away the last year and they'll rank in the top decile of performance virtually across the board. I think over the last 5 years, they're 6% over their benchmark, over 5% over the last 7 years. So they are a volatile manager, but they have done very well for the city.
I mean, I think that we look at that as kind of like the higher beta part of the portfolio. You know what I mean? It's like, we're just thinking that they could come up with big numbers or lose money. You know what I mean?
Yeah, I just know that SMID there's been a lot of new product and new managers in that area.
Yeah, maybe
where they.
And just to give you an idea in terms of our SMID cap growth peers, even with a negative 1-year return, they rank in the 63rd percentile of peers. So, the median peer was down 28.5% and they were down 29.9%. So while there is dispersion there, longer term, 3, 5, and since inception are right at the top decile.
Top decile?
Yeah.
Wow. Okay. So you can't. Have to argue.
Well, yeah, one of the things I'd be concerned about is that a lot of these. A lot of the SMID names have gotten hammered with COVID and the way the business models have changed and the way that the back to the or not back to the office and those sorts of things where sometimes turnover is a good thing.
Right. Exactly.
They're holding on to some to some name that the world has changed and they're still thinking it's going to come back, and yet there's been 4 years of 24% EPS decline.
Yeah, absolutely. And Columbus Circle historically has been overweight in tech, which hurt them in the fourth quarter pretty bad. And healthcare. They're underweight healthcare now, but their healthcare names in biotech they got hit pretty hard. We did get some feedback that they've reduced their healthcare underweight further. and they've actually increased their tech exposure, which is really kind of the core of what they do. But I think hearing from them on their positioning and why they're positioned that way would be good.
The one thing that they do have, they have maintained the 6 clients, right? They haven't lost anybody.
So we monitor that
Okay.
on a quarterly basis to make sure that their client base continues. They know to notify us if they lose any clients. I think the one piece that gives us a little bit of security is that they're now part of a larger parent. Given their track record, the hope is that having access to these distribution channels can increase the size of their funds. And they're not a standalone asset manager that really has a break even at a level that they couldn't sustain. So I think without that, we would probably not be having the same conversation.
Because we had, one of the problems we had with Zeisinger was that it got down to being, and by the way, just for the record, I still get a monthly update from Zeisinger. It says 0.
It's never, the commentary is always interesting to me.
Yeah,
Somehow still optimistic.
yeah, we're still optimistic, but right now the value is 0. Yeah. Anyways,
So those are our comments on performance. Happy to take any questions.
any questions on performance?
No, good.
We did discuss cash needs, but I don't know whether you want to go into any other detail or anything, basically.
There's not much detail. I mean, we're still, our payroll for pension, it's still around 3.3 million, and we're still getting, contribution from the current active employees going into that fund. So that's around 280,000 or 300,000 each month. So, for the cash needs to get me through June 30th, I'll probably just need 3 million.
Frank, we put together this that I handed out to you. PIMCO, I know we took some money out of there in the fourth quarter, I believe. It is overweight, it's daily liquid. One of the other places that's overweight, given how well they did last year, is UBS. So we did, for future liquidity needs, we can discuss this at April's meeting. Their deadline to submit a rebalancing or redemption request is April 26th. And you would expect to get the cash towards the end of July. Certainly not something that is necessary, but I think at some point, given their performance and the overweight, it might be reasonable to look at taking some of the gains from UBS in 2023.
Between now and April, though, you have no needs, right?
Yeah, because I'll get that redemption, partial of that redemption from Blackstone.
And they'll carry, will that be enough to carry you through?
I'll probably need it in June,
Okay.
at 3 million.
Any other discussion? Any other questions?
So do you want us to bring back a different proposal in May, or
For cash allocation?
usually we were doing it in March, June, September, and
Right.
December? So that's why.
Yeah, I mean, I think one of the things is because when we did that March 2, we weren't anticipating that we'd be getting money from.
Right.
You know, so we're gonna be getting an allocation. Are we gonna, what are we gonna get in April? Isn't it like 4 million?
4.9, which is why the
4.9.
request from Chitsame is so much lower. So it's only
Right.
3 million, which is what we are suggesting to take from PIMCO.
You wanna take it from, pardon?
PIMCO, all asset is what we are suggesting.
Did we just take money from PIMCO?
We did.
And aren't they doing better than most?
They're doing well.
Yeah.
And they're also overweight.
Right.
And one of the liquid asset classes that is daily liquid.
What do you guys think? We need $3 million, where, any place? Charlie or Jim?
Well, they are, let's see, where are we with, yeah, we're at 7.5% to them. Yeah, I'm a believer in asset allocation guidelines, so. And what's our range for real assets?
It is 4 to 10%.
Yeah, so we're just,
In the middle, yeah, we're good, okay.
in the middle.
Yeah, I would say take it from PIMCO as well. They're a little high.
Is there a motion?
Motion
need it.
to,
Do we need it now or can we
Yeah, do
wait?
we need it now? Can we wait till April?
Yeah, if she doesn't need it till June, we can wait till April or May.
Yeah,
Sure.
Yeah.
Whatever the-
all right. So we're not gonna. We're all set with that. So our cash needs are all done. So the last item on the agenda is adjournment. Is there a motion for adjournment?
so moved.
Second, all in
Second.
favor?
Aye.
Aye. Passes unanimous. Thank you very much. Next up, OPEB. I'd like to call the meeting of the other post-employment benefit committee. And seek approval of the minutes from December 14th. It's a very brief. Any
Motion approved.
second for the motion?
Second,
I'll second that.
That's unanimous. Excellent. Public comment? Thank you very much. Performance review.
Great. So I'll start on page 3 of the January report. Total assets about 126.2 million. Slight underweight to domestic equity and international equity, as well as fixed income. I think one of the reasons is we raised cash, if you recall, for the first time last month. You can see $6 million coming really from across the board within equities, fixed income, and real assets, which will be, you know when that's expected, or has it already been paid out?
We already have it.
Okay.
So it's earning.
So you can see that cash is there. In terms of performance, again, similar story to the pension plan. We've seen your funds have tracked their benchmarks well. There is some fair value pricing in the Vanguard International Fund, given month-end pricing when the markets are closed internationally, but longer term continues to be in line. And you can see really driving the outperformance and fiscal year up about 7.3%. And longer term returns continue to be good. Any questions on OPEB performance?
One of the questions I had, there was some discussion about in the new budget, how much money that OPEB is gonna get or not.
In July,
Yes,
yeah, it's definitely lower than in previous years, just because the OPEB fund is at a really good funded ratio. I think it's around 80%. So fiscal year 23, I believe it's only 2 or 3 million. So the coming year, it's probably going to be around the same amount. So it's not going to be high as it used to be. I don't remember, it was 6 or 9 million around there.
it used to be 9, I think.
Yeah.
And now it's gonna be much lower than
Correct, yes.
And I think that'd be good to ask the actuaries about, because OPEB funds, as you've heard from them, a lot of cities and towns fund as they go and really have not allocated assets and made contributions, and Norwalk's been very good about it.
Right.
And that's why the plan's in such good shape.
Does anybody have any questions for the OPEB? If there's no questions, and if nobody wants to suggest the next time we have lunch, or dinner,
Motion to.
first motion to demand
adjourn.
sandwiches.
yeah, food would be good.
I'll be there next time for sure.
Okay.
Yep.
So with that said, is there a motion for adjournment?
Move to adjourn.
Second,
I'll second.
all in favor? Aye.
Aye.
Pass unanimous. Thank you very much, gentlemen,
See you next
Hey.
month.
everyone.
Thanks, Charlie.
Thank you.
We do have extra N95 mats over there in the corner.
Oh, yeah.
Yeah, I saw the city of New York had lots of extra ones.